You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com. Over the past decade, no verified multimillionaire has attributed wealth creation solely to holding a life insurance policy, apart from those who inherited wealth through structured trusts. While life insurance delivers financial proceeds, it is rarely the single origin of significant wealth. Cash value whole life insurance remains widely misunderstood. When used properly, it acts as a long-term asset within a balanced portfolio, providing consistent growth, access to liquidity, and protection from market volatility. Properly structured policies offer unique benefits: stable returns, policy loans that can be tax-free under current tax codes, and a death benefit that transfers wealth without the same tax burdens as other assets. The phrase infinite banking became popular because it ranks highly in online search terms, but the principle behind it centers on building liquidity and leverage. The concept allows policyholders to access cash value that grows even while being used elsewhere. However, public understanding often stops at this surface level, missing the larger picture. Too often, promoters of whole life insurance use unrealistic performance illustrations. Real-world results depend on how and when funds are added or withdrawn. Average returns do not show the full impact of timing. Two investors could each average 4% annual returns, yet finish with vastly different outcomes because of when gains and losses occur. Cash value whole life insurance should be viewed similarly to how previous generations used bonds, a reliable, conservative place to store wealth safely while seeking growth elsewhere. Bonds once filled that role, but market conditions have made bonds volatile in recent years. Bond indexes that traditionally held fixed income allocations experienced steep declines when interest rates rose, showing that even so-called safe money carries risk. A whole life policy avoids that volatility by design. The underlying guarantees and steady dividends make it distinct from equities or bonds. It is not a replacement for growth-focused assets like stocks, but rather a stable core that balances a diversified portfolio. Comparing whole life insurance to stocks is like comparing a sports car to a family utility vehicle. Both are vehicles, but they serve different purposes. The sports car delivers speed and excitement, but carries higher risks in poor conditions. The family utility vehicle offers dependable performance, safety, and flexibility in various environments. Market conditions, inflation, and concerns about currency devaluation often push some individuals toward commodities like gold. Gold can hedge against risk, but comes with its own fluctuations. Over the past 2 years, gold prices have repeatedly bounced between 1,600 and 2,000 United States dollars per ounce, following broader market trends. Some worry about the global reserve status of the United States dollar. However, major alternative currencies face the same or worse debt burdens. China, for example, carries total debt exceeding 270% of gross domestic product. Other advanced economies also maintain debt levels that match or surpass the United States on a percentage basis. Global debt issues make a total collapse of the United States dollar unlikely in the near term. Established insurance providers such as MassMutual and Northwestern Mutual have paid annual dividends without fail for over 150 years through world wars, political crises, assassinations, and recessions. These companies demonstrate how a conservative financial tool can endure economic uncertainty when structured properly. Wealthy individuals may not publicize life insurance as an exciting topic. Discussing high-growth stocks or aggressive market wins tends to generate more attention at gatherings than describing steady cash value growth inside a life insurance contract. But that steady growth, quiet and consistent, remains part of how many families protect wealth across generations. A properly structured whole life insurance policy operates best as one piece of a larger puzzle, alongside equities, real estate, and other appreciating assets. In times of market downturns, having this stable liquidity source allows for greater flexibility. Funds can be withdrawn from the policy instead of selling investments at a loss, preserving portfolio value and enabling the owner to wait for market recovery. A properly structured whole life insurance policy provides flexibility beyond simple death benefits. This flexibility becomes clear when comparing investment and asset allocation choices during different economic conditions. Many individuals focus only on high-return assets like equities, assuming consistent upward performance. However, market cycles include downturns, and downturns often arrive unexpectedly. A life insurance policy with accumulated cash value can act as an emergency liquidity source or an opportunity fund. When other asset values decline, using the cash value avoids liquidating stocks or real estate at depressed prices. Once markets rebound, the capital that was temporarily withdrawn can be repaid into the policy. This preserves the long-term growth of appreciating assets while keeping funds available when needed. Properly structured whole-life policies can complement other conservative assets like bonds. For example, fixed-income bond indexes have shown clear risks in recent years. When interest rates rise, bond values fall, and this can catch even experienced investors off guard. Unlike bonds, cash value inside whole life insurance remains stable and accessible regardless of external rate swings. While stocks and real estate provide growth and potential high returns, they also bring volatility and market risk. Real estate investments, especially rental properties, generate passive income but can face challenges such as tenant non-payment during economic downturns or sudden regulatory changes that restrict evictions. Whole life insurance cash value is not dependent on tenants, occupancy rates, or market cycles. For business owners, whole life insurance can support strategic financial planning in several ways. Policies may be used to fund partner buyouts, insure key employees, or create tax-efficient generational wealth transfers. The death benefit provides funds at a fraction of the cost compared to building that same value entirely through cash or other appreciating assets. Additionally, a business can use cash value as an alternative source of liquidity. Business owners often face cash flow constraints, especially during periods of expansion or unforeseen downturns. Accessing cash value can prevent the need to seek bank loans with lengthy approval processes or unfavorable terms. Instead of waiting months for financing, cash value can be deployed immediately. Beyond immediate needs, whole life policies can also help balance tax exposure during retirement. Traditional retirement accounts limit how much can be contributed annually and often tie up funds until a specific age. High-income earners and business owners frequently hit these contribution caps quickly. For them, a whole life policy acts as an additional bucket for accumulating assets outside traditional retirement vehicles. If market conditions shift and an investment portfolio declines, drawing funds from a whole life policy instead of selling depreciated assets can help maintain overall portfolio health. Once the market rebounds, the funds can be repaid, leveraging the appreciation to keep assets working efficiently. This approach reduces the impact of sequence of returns risk, where withdrawals during a down market lock in losses that are difficult to recover. Generational wealth transfer is another advantage. Many high net worth families hold large percentages of assets in real estate or businesses. When those assets pass to heirs, liquidity challenges may force sales at unfavorable times. A death benefit from a whole life policy provides heirs with immediate funds, reducing the pressure to liquidate real estate or business holdings during weak markets. Estate planning can integrate life insurance to offset taxes on large estates. While laws and thresholds vary, taxable estates above federal or state limits may trigger significant tax liabilities. A properly designed life insurance strategy can help cover those costs, allowing more of the original estate to stay intact. Real-world historical data reinforces how consistent these tools have been. Major mutual insurers, including MassMutual New York Life and Northwestern Mutual, have weathered world wars, market crashes, and financial crises without missing dividend payments. Such resilience offers peace of mind in unpredictable times. Gold is often mentioned alongside insurance as an alternative asset for hedging against currency risks. While gold can be a store of value, its price still moves with market sentiment and global economic shifts. Anyone holding physical gold also faces storage and security concerns. Gold priced in dollars shows that the dollar remains the measurement standard, highlighting how intertwined gold's value still is with the broader currency system. When comparing asset classes, each serves a distinct purpose. High-growth assets aim to maximize returns. Conservative assets like bonds and insurance policies provide stability. Alternative assets like gold hedge against uncertainty. A balanced portfolio uses all three, allocating based on risk tolerance, goals, and time horizon. The strongest financial strategies avoid placing all assets into a single vehicle. Diversification remains vital. The biggest endowments and institutional investors show how combining non-correlated asset classes can protect against large swings and unpredictable cycles. Sound portfolio construction always considers cash flow, liquidity, and tax efficiency. A properly structured whole life insurance policy addresses all three. Unlike many investment accounts that are restricted or penalized for early withdrawal, the cash value inside these policies remains accessible at any age as long as premiums are paid and the policy is designed correctly. This flexibility gives owners the ability to respond to opportunities or emergencies without disrupting other parts of a wealth plan. For example, a downturn in rental income can put pressure on real estate investors. If tenants cannot pay or markets stall, maintaining properties becomes expensive while revenue drops. In such situations, life insurance cash value can supply temporary funding until rental income recovers or properties are sold at better market rates. This prevents forced sales at depressed prices. Beyond individual investors, business owners often use whole life insurance for key person coverage or as part of succession plans. If a vital partner passes away, the death benefit can help buy out the deceased partner's share, pay off debts, or provide stability during transitions. The same death benefit can also secure loans, offer collateral for expansion, or fund executive benefit programs to attract and retain talent. One of the greatest advantages for high earners is the tax treatment. While regulations vary and require careful compliance, cash value growth within a whole life policy generally grows tax-deferred and can be accessed through policy loans that are often tax-free if structured correctly. Death benefits are also designed to transfer tax-free under current laws, which is a powerful tool for passing wealth efficiently. A diversified approach means cash value. Whole life insurance should not be the only source of passive income or liquidity. Combining this conservative base with appreciating assets like equities and real estate creates a blend of growth potential and security. Stocks can deliver higher returns but fluctuate with economic and market cycles. Real estate can appreciate and generate rental income but carries market risk and management responsibilities. Life insurance, in contrast, stays steady and predictable. Properly balancing these pieces reduces overall concentration risk. If one area underperforms, others may remain stable or even benefit. The goal is to avoid relying on a single source for all future income or liquidity. Large institutions and endowments demonstrate this by spreading their capital across public markets, private investments, fixed income, real assets, and other vehicles, constantly adjusting allocation to meet shifting conditions. When comparing vehicles side by side, each reveals its role. Stocks are the performance engine for growth but bring volatility. Real estate produces income streams and potential appreciation but can become illiquid or costly during downturns. Whole life insurance does not replace these but supports them with stability, accessible cash value, and a reliable death benefit. Long-term financial success relies on maintaining options. Liquidity means more than just having cash in a savings account. It means having multiple sources that can be tapped without eroding principal value or triggering large tax consequences. Cash value whole life insurance is one source that, when integrated well, strengthens this safety net. Many wealthy individuals do not highlight their life insurance holdings because the returns are steady and predictable rather than dramatic. At gatherings, people prefer to discuss stocks that doubled in value or real estate flips that produced massive short-term gains. However, the steady buildup of cash value and guaranteed payouts help wealthy families preserve what they built, shielded from sudden downturns and surprises. When reviewing portfolios, the strongest evidence of success appears in resilience during economic shocks. Over generations, major mutual insurers have maintained annual dividend payouts even during wars, recessions, and financial crises. This track record demonstrates the reliability that makes conservative asset classes worthwhile. Sound planning always asks the same question: how does each piece fit into the whole? Cash value. Whole life insurance is not the destination, but a vehicle that supports reaching other destinations. With clear structure, tax advantages, and built-in protection, it helps protect legacies, balance risks, and provide options when markets shift. Holding multiple vehicles is not about chasing maximum returns at every turn. It is about having the right tool for the right moment. When volatility strikes, stable assets sustain families and businesses while other assets recover. When opportunities appear, liquidity fuels action without costly delays. Successful investors do not rely on absolutes. They avoid words like always or never. They adjust to new conditions and stay diversified. They respect conservative tools that work behind the scenes, delivering calm in storms and safety when markets roar. The quiet, steady build of a cash value policy may never grab headlines, but over time, it remains one of the most overlooked assets in protecting wealth, providing flexibility, and giving families freedom to act with confidence for generations ahead.